Welcome. You're watching a special conversation that we're having with Sandeep Kalra, CEO of Persistent Systems. Sandeep, good morning. Thank you very much for joining us. From the look of it, it's been a good quarter. Like you mentioned to me before we got into this conversation, 17th quarter of reporting, and you've done good. Revenues are up, EBITDA is up, margins have also improved. So all in all, from the look of it, things look good. But let's start with the demand environment first. Has that changed in between the last quarter and today? We've talked about green shoots. Are we actually seeing green shoots today as we speak? And also, do you feel a lot more confident? Do clients feel a lot more confident going into conversation and closing deals with companies like you? So a quick check of what's happening on the demand front.
Yeah. So first of all, thank you for having me. It's been a good quarter for us, both in terms of revenue, profit, as well as the order book. In terms of the demand environment, as you alluded to, the demand environment continues to be somewhat the same, although there is a bit more optimism. There's a bit more optimism from the perspective of rate cuts, etc. happening. People are expecting September they will start to see some amount of rate cuts, and post the elections they do expect things to accelerate. So there is some amount of optimism. I would say it is not necessarily converting into order wins yet, but the discussions are starting to turn a little bit more positive.
Sandeep, when I looked at your earnings last quarter around healthcare, it held up quite nicely, but BFSI and high-tech segments were still not looking as good. From the way we look at it today, all those three verticals are firing up. Your BFSI is growing and so is healthcare. You want to chart out and pencil out what sort of growth can we expect for FY25 on those two verticals?
Sure. So we don't give forward-looking guidance, so I'll not give you percentage commentary, but I can give you qualitative commentary on things, which should help. So if you look at our, pipeline and order wins and so on, so the order wins have been fairly secular. Order wins have picked up on the back of generative AI-related discussions in software product engineering, and so we are seeing the success based on our platform SASVA that we are bringing to bear, especially on the cusp of enterprise software and private equity and mid to large, enterprise software companies. So we do expect that to accelerate our high-tech, revenues or ISV revenues over the next several quarters. Healthcare has been a very good journey for us. We have won multiple large deals in multiple customers. It has been a story where we have grown 66% year on year. Sequentially, we have grown, several quarters, double digit from a growth perspective. BFSI last quarter saw a fairly decent growth. So we are expecting healthcare to lead the growth, followed by BFSI, followed by high tech for us. And overall, the demand environment for us, I think, based on the initiatives we are taking, looks decent.
Hello, Mr. Kalra. Thank you so much for joining us today. I just had one question on margins. Now, we've seen, on an absolute basis, of course, they've gone up on a year-on-year as well as on a quarter-on-quarter basis. But it's coming at roughly 14% versus 14.9% in the same quarter last year. If you could just talk us through, you did speak about demand. If you could just talk us through on margins specifically, how are you seeing the current negotiations as well, and anything on qualitatively, or just you could tell us about the story as well on margins going forward.
Sure. So if you look at the margin side, there is 2-3 things happening there. Number one, overall, if you look at the last year, the environment has been tough. So while there have been larger deals on the table, those deals have been led by cost optimization initiatives from our customer side. So when they are trying to do cost optimization, they are looking at doing vendor consolidation as well. So a number of larger deals that we have won, we have done rebadging onshore, consolidated vendors onshore. We will optimize this over a period of next several quarters offshore. That will be a margin lever for us. So if you look at it, increasingly we have won against the bigger players in a cost optimization initiative, and we feel good about it. The revenue growth in a difficult environment is definitely a sign of continued revenue growth as the environment eases, and it also gives us the levers to be able to optimize margins. We have said aspirationally we want to deliver industry-leading growth at margins which are equal to the margins that we delivered last year. What that would also mean is if we are starting with 14% in the first quarter, which is lesser than the last quarter, we will incrementally see margin improvement. And by the time we exit the year, aspirationally, we should be meeting the margins and setting the base for margin improvement to come for the next several years.
I'm just going to come in there as Sandeep, and this may be a little more qualitative in that sense, but what you indicated to me is that you've gone in and won clients and orders in terms of cost optimization. Are you now beginning to feel that post-completion of those jobs, the money that is saved is now going into your discretionary products? So is there a cross-selling selling opportunity that is probably contributing well to your top line, or could do so in the next 6 to 8 months?
So an excellent point. Yeah. So look, what is happening in the industry is this. On one side, there is significant buzz around newer technologies like generative AI and AI at large. Now, if people have to experiment with those technologies, leverage those technologies to disrupt their business models, be more competitive, etc., in a demand environment where our customers are also facing tough conditions, they're trying to optimize spend from certain areas, put it into next generation areas. And to your point, yes, it is a good thing for us. On one side, we are winning cost optimization deals, and as and when we give back the money to the customers in terms of what we are signing up for, part of that will also come back to us in terms of next generation initiatives, which are revenue enhancing based on newer technologies and newer initiatives. So yes, it could mean revenue growth from both perspective for us.
Just one quick question on that. Have you lost any clients this quarter or added any big significant ones that you should tell us about?
No, in terms of losing any customers, look, we are always looking at long tail rationalization. So there is nothing that, we can say we have lost a customer that we did not want to lose. In terms of, adding any significant customers, look, we keep adding customers. But if you look at our order wins, we have announced certain large deals, etc., with some of our existing customers and newer customers. So I think overall it's a healthy journey. I don't think there is anything in terms of any negatives that we should be reporting. I think the order book that we have done, the deal sizes that we have seen should bode well for our future.
Now, so just as we were speaking about order books, now we have mentioned that your top 10 clients share has been steadily going up over the past few quarters. We've also seen additions in this particular quarter on your TCV as well. We saw a big jump in Q3 of last year, crossing the 500 million mark. How are you seeing on these two parameters going forward on the top 10 as well as on bookings? We have seen increase from the previous quarter. How are you seeing the demand environment on these four aspects?
Yeah, so just to give you some numbers, our top five customers grew year on year 28% in the quarter gone by. Top 10 grew by 21.5%, top 20 by 19.3%, and top 50 by 19%. So if you look at it, our endeavor to grow our top accounts, if you look at our current growth rate, we are at 16% year on year. All of these categories are growing higher than that. So the initiatives that we have on focusing on our larger accounts is paying out well. We are also winning newer deals at scale. So from that perspective, the bookings are panning out nicely. And Q3 for us, usually, if you look at it, is the October, November, December quarter, which is the financial year end for US. It's seasonally a stronger quarter for us. So we are hoping as we are increasing our revenues, the order book should also proportionately increase with time. So all healthy trends and trending in the right direction from customer concentration, order book, and every other perspective.
Right. The biggest talking point these days is Gen AI. Most of us understand very little of it, unlike, of course, people like you who know this at the back of your hand. So it's mandatory for me to ask you this, right? Where do you see yourself, or where do you see Persistent? So a forward-looking guidance over the next 2 to 3 years. And where do you see Gen AI? How much of it is that going to be the lead indicator for the revenue growth or the $2 billion aspiration that you have for Persistent?
Yeah. So look, Gen AI is a subset of AI. We have been playing in the AI field for long, but Gen AI has definitely, been something which is transformational. It is not an incremental thing. And the fact that everyone is talking about you, including you on this call, the awareness is very big. The adoption is going to be much faster than even the cloud adoption we saw in the past. And so from our perspective, we are looking at Gen AI/AI in two vectors. One, AI for technology. Second, AI for business. AI for technology, we are focused on using AI to do product development, application development, etc., faster and making it more platform driven. So forward looking, Persistent should be looked upon as a company, whether we are doing AI for technology or AI for business, where we are helping enterprises develop new business models, reduce cost, use data to insight and action, improve customer experience. You should look at Persistent as being a company which will scale revenues based on a platform and human centric approach rather than being a human centric services delivery arm. So from that perspective, over the next several years, and please don't expect it in the next quarter, 2 quarters, our revenue per employee should move up our profit per employee should move up because we are doing a platform and services. So the platform should become something that can increase productivity of an average employee in Persistent. That'll help us disrupt our own business and the business of our competition and so on. And overall, the market would also expand. So that's where the story is. It should be revenue and margin accretive over a period of time.
Right. So, of course, from what I understand, a lot of the tech you're developing or AI you're developing is first being used internally to improve, utilization in that sense, and of course profitability, and then of course is also sold to other companies to do so. You've also talked about expansion, growing at the pace that you're looking to grow. Would any of it come in from the inorganic acquisition route? And if yes, would that be in the Gen AI space? So are you on the lookout for a good match for yourself or for your company?
Sure. So look, we have been doing inorganic part as well in terms of acquiring companies for capabilities that we want to get into. So in the last several years, we have incrementally invested in cloud-based technologies, payments, and so on. As of this point in time, from a Gen AI perspective, there are certain use cases which are horizontal use cases which are applicable across verticals. So, for example, contact center, infusing AI into contact centers is one big horizontal use case. We recently announced a small acquisition in that space, and we'll build it up to bring in technology from our side, our partners like Google, Microsoft, Amazon, and others. So like that, we are on the lookout, and we will definitely do both. We'll create IP internally as platforms and reusable components and bolt on these acquisitions, most of which should be smaller tuck-in capability based acquisitions.